Welcome to our channel, where we dissect trading techniques, strategies, and theories to make you a more skillful and proficient trader. Today, we are going to delve into an often underemphasized yet critical step in the trading process: screening of trading assets. The importance of screening cannot be overstated. It's more than half the battle. This initial choice will set the tone for everything that follows in your trading process: your strategy, risk management, potential returns, and indeed, your peace of mind. Imagine walking into a marketplace with a shopping list. You don't want to spend hours examining every single item on every stall. Instead, you apply filters based on your preferences. Maybe you're looking for specific brands, items with certain features, or items at discounted prices. In a similar fashion, screening of trading assets allows you to swiftly sort through the multitude of options and focus on the ones that match your predefined criteria. So, how do we pick the right assets? It's not a random choice, but a thoughtful decision involving several key considerations, such as market structure, volume and volatility, liquidity and slippage, historical data, and an in-depth understanding of the asset's fundamentals. Market structure. The market structure plays a crucial role when choosing an asset. A clear and consistent market structure can signify predictable and easily identifiable patterns, trends, and key support and resistance levels, presenting trading opportunities of higher quality. Conversely, an unclear or complex market structure can pose challenges in anticipating price movements, potentially leading to more frequent stop-loss triggers and a higher potential for losses, thereby offering less clear-cut trading opportunities. Therefore, it is imperative to carefully select and focus on trading assets that exhibit a clear market structure. Volume and volatility. High volume and volatility are essential preconditions for profitable trading. High volume signifies a substantial level of trading activity, indicating strong market interest in an asset. Similarly, high volatility indicates a considerable degree of price fluctuations. Assets that exhibit both high volume and volatility tend to experience larger price swings, which can typically create numerous opportunities for traders to capitalize on short-term price movements. The 24-hour price change is a common and useful indicator used to assess an asset's volatility, which can help filter out assets with low volatility. Let's consider two contrasting assets. One exhibits a dramatic 100% price change over the past 24 hours, signaling high volatility. In contrast, another asset might show only a 1% change in the same period, indicating low volatility. The asset with high volatility obviously offers more trading opportunities and higher potential for profit. Furthermore, the importance of volume cannot be overstated, even in highly volatile markets. If the trading volume is low, it could be a warning sign. Low volume implies fewer market participants, which can lead to erratic price movements and increased risk of price manipulation. Therefore, an ideal trading environment often combines high volume with significant volatility. This can provide a more transparent market, where price movements more accurately reflect genuine market sentiment, rather than being influenced by sporadic trading or manipulation. Without these two key factors, you might find it difficult to identify high-quality trading opportunities. Liquidity and slippage. Liquidity is another vital precondition for profitable trading. A liquid market allows traders to enter and exit positions seamlessly without causing a significant impact on the asset's price. This is particularly crucial in highly volatile markets where large orders can cause considerable price swings. In the trading context, slippage refers to the discrepancy between the expected price of a trade and the price at which the trade is executed. Imagine you're trading a low-liquidity cryptocurrency, and you use a market order to buy 100 units at $100. However, due to the thin order book and poor liquidity, the price rapidly rises, and you end up buying at $103 per unit. This $3 per unit difference is the slippage in this case, a factor that can significantly impact your average position price and overall trading results, especially when dealing with larger order sizes. Slippage is more likely to occur in less liquid assets, where there's a scarcity of orders at the desired price level. Conversely, assets with high liquidity, such as Bitcoin, Ethereum, and Binance Coin, typically have robust order books that minimize slippage. Therefore, it's imperative to carefully assess the depth of the order book before executing a trade, and consider both the size of your trade and its potential impact on the asset's price. If you're planning to trade a less liquid asset with a substantial position, you might experience significant slippage. In such cases, it might be wise to either seek alternative assets with higher liquidity. But if you insist, it is advised to break down the trade into smaller segments and execute them separately for several times to mitigate slippage. The length of historical data. Next vital precondition for profitable trading is the availability of sufficient historical data. Technical analysis relies heavily on historical data. Traders analyze historical price movements to identify trends, patterns, and support and resistance levels that can forecast future price behavior. Therefore, when an asset is relatively new or obscure, with a limited trading history, technical analysis might not be as effective due to a lack of significant data to establish any concrete patterns or trends. For instance, imagine an asset that has been on the market for only 3 days. While this asset could be volatile and potentially profitable for short-term trading, it lacks the historical data required for comprehensive technical analysis. The patterns or trend that appear over such a short period may be short-lived, driven by initial market hype rather than sustainable market forces. In contrast, consider an asset with several years of trading history. This asset's historical data reveals long-term trends and cyclic behavior, key resistance and support levels, and reactions to different market conditions. This rich history can help traders identify high-probability setups and make more informed trading decisions. News and events. Staying informed about market-relevant news and specific events is paramount for your successful trading journey. Market dynamics can be significantly influenced by external factors, making it crucial for you to keep up to date with the latest developments. For stocks, this might involve tracking earnings reports, mergers, acquisitions, and regulatory changes, and so forth, as these can swiftly impact stock prices. For cryptocurrencies, unique events like major partnerships, new listings, regulatory decisions, or protocol upgrades have the potential to trigger substantial price movements. By actively monitoring and analyzing news and events, you could better anticipate shifts in market sentiment and thus reinforce your technical analysis. For instance, consider the Bitcoin halving event that occurs approximately every 4 years. During a halving, the rate at which new Bitcoins are produced is reduced by half. This scarcity-driven event often leads to increased demand, potentially driving up the price due to the reduced supply. In this case, you can integrate this expected impact on price appreciation with recent price movements and your technical analysis. If these various factors collectively indicate a bullish trend, then opting for a long position could be more advantageous and likely to yield profit. Consider another example. Let's say a major exchange announces the listing of a lesser-known cryptocurrency on its trading platform. Such news is likely to increase both exposure and liquidity for the cryptocurrency, leading to a surge in trading activity and potentially driving up its price. Staying informed about such developments may help you capitalize on the price movements resulting from increased market interest and make timely trading decisions. However, it's essential to recognize that while news and events can bring profitable opportunities, they also come with risks. Rapid and volatile price fluctuations caused by news can result in unexpected outcomes. Therefore, it is wise to exercise caution, verify sources, conduct thorough research, understand the overall market situation, and consider the potential long-term effects on market trends before making trading decisions. Aligning with your trading style and strategy. Remember, it's important to select assets that align with your personal trading style and strategy, whether you identify as a swing trader or a day trader. For example, day traders may lean towards assets with high volatility, aiming to capitalize on rapid price movements for quick gains. In contrast, swing traders might prefer assets exhibiting well-defined, stable, and sustained trends, which allows them to capitalize on more gradual price movements. Thank you for watching this video. Feel free to drop any questions in our Telegram group, and we will do our best to provide answers. Engaging with fellow traders can also provide valuable insights and different perspectives. As always, trade smart, and we'll see you in the next video.